Realty Income reported its earnings last week, but is it still an undervalued buy now? We can already see a double buy rating and in fact one strong buy rating, and in today's episode we are going to do a deeper dive. We're also going to look at their latest investor presentation just from a few days ago. Now this is definitely one you do not want to miss if you are a shareholder or thinking about buying or selling. We're also going to take a look at some insider movement. We have seen some insider selling very recently, as well as looking at both institutional buys and sells over the more recent quarters. We're also going to touch upon their dividend safety. Now, this is very important given the fact they do pay a yield of around 5.6%. We'll also look at some of the underlying metrics, get an updated outlook, and based on that latest earnings, we want to see how their top line revenue has been growing, as well as their bottom line net income. Also have a look at the information they've now released on their latest cash balance, as well as their total debt. So a look at the health of this company. And as always, we are going to get and run it through the valuation method. We want to get to our own intrinsic value. What is our acceptable buy price? Now we have the updated information. This is all going to be based on our investor margin of safety that we will run through. And as always, we will look at the forecast that Wall Street have over the next 12 months. Now, today's analysis may surprise you as well as the conclusion. So let's jump in first with our bit of element of looking at the historical performance. Now, over the last 12 months, they are down around 12%, as we can see here. Year to date as well, they are down just over 4%. But if you have been a long-term shareholder, you would now be up around 29%. Bear in mind, it doesn't include those dividends reinvested, which for Realty Income, they do pay every single month. And we see their all-time highs just before the pandemic at around $80. In terms of the price at the moment, they are trading now in the midpoint of the 52-week range. They do have a forward yield of around 5.61% and a P to FFO of 13, which we will analyze versus others in the industry. Now, in terms of how they've performed on a year-on-year basis, for REITs, we target 5 to 10% growth, and we do in fact notice their top line has increased more than 4 times, 934 million to just over 4 billion in December 2023. And when we look at it on a graphical basis, very important to note that they are continuing to increase year on year, and their acquisition, which is finalized now of Spirit Realty, is looking to continue to propel that top line into future growth. In terms of their bottom line net income, well, is it a very similar story? We see 271 million reported as net income in 2014, 872 million in the latest annual report. Now, we do note it has increased by around 3 times, so not as quick as the top line revenue, and we do also note some inconsistencies over the last 10 years. In fact, just over the last year, we do see it is fairly flat. So we can take a more analysis approach to understanding the reasoning behind this and whether or not that Spirit Realty will sustain that continued growth on the bottom line moving forwards as well. In terms of the health of the company, total cash versus total debt, around 4 million of cash in 2014, 680 million in their latest report. So they do hold a significant amount more cash now than they did 10 years ago. But again, very inconsistent as we see year on year. Now, just off this alone, that won't tell us much. Let's compare it to their total debt numerically and directionally. And what we can see, it has gone from just under 5 billion in 2014 to around 26 billion in that latest report. So we do see around 5 times growth on that total debt, and we can in fact see whilst cash has been very inconsistent, their total debt continues to climb. Now, that isn't something that is essentially inconsistent with other REITs. It is something they take on a lot more debt to grow. But as always, this will be important when we do jump in to essentially the dividend safety to understand if the monthly dividend is being able to be supported. Now, in terms of the FFO, what we typically like to see on this part of our analysis is how they've performed against analyst targets. Now, over the last 4 quarters, they have missed, so they have a 50% track record of at least hitting it or beating it. Not the greatest, not the worst, although we do want to point out the last 2 quarters they have missed on that FFO. When we take a look moving forwards, what we do know year on year, they are anticipating at least for the next 3 quarters to be single-digit growth. When we look at Q1 of 2025, they are expecting around double-digit 15%. So that could be where we start to see the effects of Spirit Realty really help growing this company's FFO, their funds from operations. Now, when we move on to essentially some analysis in terms of gradings, we'll start off with the valuation grade. Now, they do get a C+. One thing we do want to point out with other companies, we always start off with the PE on a non-GAAP basis. As we can see here, this is their last close price divided by the next year's expected EPS estimate. However, for essentially REITs, we do tend to focus on the P to FFO on a forward basis. This is essentially their last close price divided by next year's estimates for the adjusted funds from operations. Now, when we take a look, we can see 13.2. They do get a B- for this specific grade. The reason for this, it is marginally lower than the sector median, around 14.61. In fact, we can see discounted around 10%. When we move on to the next grade, we're looking at their growth, so an A+, looking very strong. A few things that we do like to look at is their historical rate. Over the last 3 years, they have increased their adjusted funds from operation year on year of 5.7%. Sector median around 4.1. When we look over the last 5 years, 4.63 versus 2.2. So we can see they are marginally higher than what the sector median is currently offering. Always great to see companies that on a valuation are lower than the sector, but growing higher. And when we look on a forward basis, 3.18, low single digit. However, the sector as a whole is expected to be even lower at 1.7%. So looking good. Some of these other metrics we will cover, like their dividend growth. But again, if you do want to see it, the information is there. You can pause and take a look. We'll then move on to the profitability grade. So they do get an A. Again, we will cover a lot of these metrics, but if you do want to take a look at any of them, you can see here they have performed fairly well. But in conclusion, when we do take a look, just to wrap this little bit up of our analysis, valuation a C+, growth A+, profitability A, whilst having a double buy rating and quant giving them a strong buy. Now, finally, before we wrap up this part of our analysis, we do just want to show you their performance over the last 10 years. Now, we're comparing them to other retail REITs, Simon Property, Kimco Realty, Regency, as well as a few others. Now, this essentially is the total return, so it does include those dividends reinvested. Over the last year, even if you have been reinvesting this monthly payer, you would be down negative 7%, the worst performing in the industry. When we expanded over the last 5 years, you would be up around 5%. Very poor, let's be honest, over a 5-year period, especially reinvesting. And over the last 10 years, what we do in fact know, they have been the best performing out of their competitors, up 103%. So if you do zoom out, they have performed fairly well against the industry leaders. But 103%, ideally, we would like to see a little bit better of a performance. Do bear in mind one thing though, that past performance is never an indicator of future performance. So if they performed 100% over the last 10 years, they could perform a lot better or in fact a lot worse over the next 10. Now, before we do jump into their investor presentation, we just want to cover some buying movements, sells, as well as buys by institutions and insiders. And we'll start off with some insider selling that we have noted. So insider ownership sits at 0.1%, and we in fact know one instant of insider selling. We can see 471,000 worth, and in fact this latest was Q2, as we can see here. So when we take a look at who this individual was, in fact it was A. Larry Chapman, the director, who did sell on 2 occasions. The latest one was 3,500 on the 18th of December. The newest one was 5,000 shares on the 9th of April, as we can see. In fact, a little bit lower than the current trading price, around $55. He did sell for around 271,000 in that latest tranche. But as always, include it. Don't include it into your own investment thesis. For me personally, it isn't one I do include, just for the fact that we don't really know when insiders, or in fact why, more importantly, they sell, whether or not personal or financial reasons. But again, transparency, we do try and show you both buys and sells if there are any. In terms of institutional ownership, we're around 71%, 1.24 billion worth of sales by the institutions over the last 12 months. We notice a fair amount more by the same institutions over the same period. And when we do take a look at every single quarter over the last few years, there has been more buying, as we can see depicted by the green, than selling depicted by the red. What we would also say is not just over the last 12 months, but also in the latest period, Q1 of 2024, we see a significant amount more of buys, 1.59 billion to be specific, versus 242 million worth sold. So again, include this if you want, but please always do your own due diligence. Never copy what insiders or what the institutions do in terms of buying and selling. So let's jump into essentially the investor presentation. We do also want to let you know that we have released our latest free weekly article. If you want to gain access to this or any others, all completely free, do click on that pinned comment, instant access straight away. We also want to draw to your attention that we have released an article here on April the 19th where we run through all the websites and resources that we use to analyze our own stocks. Do check that out if that does interest you. So after their earnings report, as we can see, May 2024, just a few days ago, they did also release their latest presentation with a lot of information. So let's jump in. First thing we do want to discuss for those that are relatively new to Realty Income, they have around an enterprise value of 73 billion. They have operated for 55 years. They have a significant number of commercial real estate properties, and we can see around 4.8 billion every year in annualized base rent. We're going to come on to their credit rating, which is very strong, and they are also the 6th largest global REIT. They have a significant European portfolio. Again, we're going to talk about one of their latest deals that they did have, and we can see here 9.4 years remaining lease term. Again, we will discuss this as part of looking at their debt summary, and we can see here 30 years of consecutive years of increasing those dividends. And we won't talk too much about this because we do want to do a part of our analysis today looking at those dividends. So a few highlights from their latest earnings Q1 of 2024. So what we can see here is they have done a lot in terms of investments, around 598 million. Average cash yield looking very healthy, 7.8%, and we can see a fair amount of this was invested in both Europe and the UK at around a cash yield, so slightly higher of 8.2%. In terms of the acquisition that we did discuss earlier, they did close the 9.3 billion acquisition of Spirit Realty January 23rd. Shouldn't be anything new. We have covered this in earlier episodes, so it is nice to note this has finally happened, and we will now look shortly at the new composition of their tenants as well as the industries they operate in. They've also affirmed their 2024 AFFO guidance of around 4.13 to 421, and this is around 4.3% year-on-year growth, so at the midpoint of what they were expecting. And there are some other bits here that we will talk about throughout the slides today. Now, the first one that we just want to talk about in terms of the shareholder return, in terms of what they do bring to those who do invest in their company, we can see here that they support around 8 to 11% of total operational returns throughout any type of business cycle. This is broken up 6% or roughly in terms of the dividend yield. Again, this depends on when you have been purchasing shares. Around 2% in internally generated AFFO, the adjusted funds from operation, 2 to 3% on externally funded. So as we can see here, between 8 to 11% of AFFO growth, and this is very good to see for shareholders, as we do want to see the higher the better, and something we will analyze year on year as well as essentially quarter on quarter with their earnings, and something we'll look at shortly as part of our dividend safety analysis. The other thing that we do want to point out here, a lot of people do talk about the high interest rate environments really hurting REITs, especially Realty Income, as it is one of the bigger ones. That does get a lot of slack all over social media, as well as amongst other investors in the community, even those who do not invest in this REIT. What we can see here is then, Realty Income have generated around 5% AFFO, adjusted funds from operation growth, which is very, very solid in both higher and lower interest rate environments. When we take a look here, 1996 to 2008, they have split up around 5.2%. When we take a look at from 2009 to 2022, around 5.4%. And throughout this period, 96 to 2022, the market has gone through several cycles. We're talking about recessions as well. So that is something that is very positive to note. But again, this may be more attractive to those who are long-term shareholders rather than those who are only looking to buy this for a few years. We then want to just discuss something that whilst we have brought up before, but they are continuing expanding into Europe, into the UK as well. And they did purchase around 82 assets across 5 countries for around 527 million. Now, for those that don't know, as we can see here, Decathlon is the largest sporting retailer good, and they do generate a significant amount of revenue, and the investment grade is very strong as well. We can see these are high-performing stores with sales around 17% above their average system, and there are a lot of benefits that this will bring to their portfolio. Now, in terms of looking at their returns over the longer term, we can see that this has compounded annually since 94, the New York Stock Exchange listing, 13.6%. The dividend around 4.3%. Now remember, on this channel we do advocate for a minimum of 4% or more just to keep up in line with inflation, and this I thought was incredible. 27 of 28 years of positive earnings per share growth as well. Very, very strong. Another thing, very high level, a lot of information. The only thing that we do want to draw to your attention is that they are one of only 8 S&P 500 REITs, so real estate investment trusts, with 2 A3/A- ratings or better. So it is looking very positive when you do take a deeper look at Realty Income rather than just a high level look. Again, a lot of this information, if you do want to take a deeper look, you can just go straight to their website, look at this presentation, but some of these we will cover, like the net debt to EBITDA, which is very important, again, for that dividend safety. Now they've completed the acquisition of Spirit Realty, we can see now the diversification of their top 20 clients as well as the industry diversification. Their top 3 clients, we have Dollar General, Walgreens, Dollar Tree, and Family Dollar. Now, we have in previous episodes spoken about the issues in terms of closing stores. If you do want to check those episodes out, do go ahead. We have talked about them in more detail when they were fresh news. But we can see a lot of these clients are very big ones that you probably do shop at yourselves and look to be here for quite a significant number of time. In terms of the industries, well, groceries and convenience do make up the largest portions of around 20%. And what I thought was quite interesting to note, the UK does make up around 11% of that annualized contractual rent, with Texas, the state in the US, around 10.5. Now, when we move on to the European portfolio, again, very important to understand, they are also diversifying. It isn't just in the US, for those that didn't know, but we can see these are very big companies. As someone in Europe, these are a lot of these I have been to, and again, there are no worries in terms of them staying as clients over the longer term. And we can see here that Tesco and Sainsbury's are the top grocers in the UK, as well as Carrefour being the second largest grocer in Spain. Another thing that we just wanted to point out, again, grocery stores, as we said, makes up 10% of their annualized rent. We can see that Realty Income's top 2 US grocery clients control around 35% of the total US grocery market. Just reinstating that these aren't companies that are going to disappear over the next year or two. A lot of people have been driving this worry to other investors, and we can see here in terms of the UK, their top 2 UK grocery clients do control around 43% of the UK grocery market. As always though, do let us know your thoughts as we go along these slides today. Now, in terms of the 2024 guidance, just a few things here. However, the main thing that I did want to point out, because one of the things that we saw when they did release their earnings was the fact that on their occupancy, it was slightly lower. We're talking by 0.1, 0.2%. What is very important to note is that for the full year, they are anticipating around over 98%, which is very strong. We want to see occupancy towards that 100% level to ensure there are no worries with their rent being paid year on year, as this is something that we did speak about quite a lot when have been reviewing Medical Properties Trust with the issues they have had from Stuart. Otherwise, everything else looks fine, as we already talked about the AFFO per share, anticipating around 4% increase year on year. Finally, before we do run into that dividend safety and talk about this, we just want to highlight a few things, or a quick reminder about their debt summary. They do hold a significant amount of debt, as we can see here. However, the main thing that we want to point out is that 94.2% of it is on a fixed rate. And when we take an average of their total consolidated debt, as we can see here, 3.88% is the interest rate, and they do have around 5.9 years of this weighted average years until maturity, so until they need to renew. And it is expected by then the interest rates will come down and they won't be as high as they are now. So in reality, if this is a worry, in my opinion, it doesn't look to be a major red flag indicator. But as always, come up with your own analysis, do your own due diligence. The information has been here in today's episode. Now let's jump into the dividend safety. Let's talk about that as well as the underlying metrics before we do jump into the valuation. First things first, dividend safety score 80. It does look to be safe. Market cap just under 48 billion. It is a large cap company. And we can in fact see their dividend safety score was reaffirmed on March the 6th. And as we can see, a dividend cut does look to be unlikely, which is always good news for shareholders, especially from this monthly dividend payer. In terms of key metrics in the last recession, well, look, they increased the dividend during the 07-09 crash. They had negative 1% sales, significantly above the average of the S&P at around negative 12. And as we can see, they outperformed the S&P, negative 43, with the S&P bringing in negative 55. Dividend growth, well, 3%, not the greatest over the last 4 years or over the last 5 years, as we do advocate that 4%. But over the last 20 years, we do know they have been increasing it 5% year on year. Always good to see. And something we haven't mentioned, but they are a dividend aristocrat, as they have been increasing those dividends for 25 years or more, as well as paying a dividend for the last 55 years without a reduction. Now, in terms of dividend yield theory, as always, it states the company is undervalued when the current yield sits above the 5-year average. So we have a sign here of undervaluation, as well as that on the forward P to AFFO, 13.1, lower than the 5-year rolling of 17.6, and marginally lower than the real estate sector at 14. Do remember though, we're not looking at any of these models in singularity and will conclude towards the end. With other companies, we do focus on the free cash flow. For REITs, a lot more volatile, so let's look at the AFFO, the adjusted funds from operations. Below 90% is the target for REITs. Not even 1 year for Realty Income has it been above that. In fact, downward trending, 73 expected in 2024, so looking very strong in terms of that safety. In terms of AFFO per share, well, we want companies to increase consistently year on year, and that is expected to continue for Realty Income, 420 in 2024 as well. What I quite like to do, quickly look at the percentage increases as well. For the large part in the single digits at the lower end, 2% in 2023, 3% expected over the next year, 12 months, and we can see for the full year of 2024 from that latest investor presentation, they are expecting between 4 to 5%. Now, in terms of revenue growth, 5 to 10% is what we want for REIT, as we looked at earlier. We can see for the majority, in fact, it has been significantly better, especially the last 3 years. We're looking about very strong double-digit growth, and we can see something numerically that we had seen earlier in a different format. Shares outstanding, now we always talk about this. For REITs, it is very important that they do need to essentially dilute your position over the longer term. Reason for this, they do retain a little of that internally generated cash flow after paying dividends. Just point out though, essentially, that some REITs do dilute your position at a much faster rate than others. Unfortunately, Realty Income is one of those REITs, so do factor that into your investment thesis. In terms of ROIC, return on invested capital, we want a minimum of 3 to 5%. We can see it has been pretty much around that year on year, so fairly consistent. Ideally, we don't want to see it dip to 2% like 2021, so hopefully they can continue around that 4% that we have consistently seen over a longer time. Operating margin, we want to see this increase year on year, so it has decreased, nonetheless still very healthy in the mid-40s as we can see every single year, so hopefully they can bring this 42% up a little bit better moving forwards, but we will keep our eye on this when they do release their annual report for 2024. Net debt to EBITDA, then the earnings before interest, tax, depreciation and amortization. Remember, it correlates to both dividend safety, balance sheet strength. Below 5.5 for REITs is what we want to see, and these are the number of years it would take the company to pay off all of their debt net of cash on hand. Has been near enough above that every single year. 6.05 expected, or in fact it was 6.05 in 2023, expected 5.23 in 2024. So we can see it is expected to be below that, so that is good news, and that is something we want to continue, giving us faith in that dividend safety as well as that balance sheet strength. Now let's jump into the valuation model, and as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now we're going to run through 4 models. The first one, Graham's valuation, it isn't relevant for REITs, so we will exclude this from our analysis. We jump into the first model, the multiples valuation model. Companies in a similar sector and size, the PAFF multiple, the average, as well as that of Realty Income at today's value, gives us an intrinsic value showing some undervaluation, $65 versus $55. But as always, bear in mind, we're not looking at any one of these models in isolation. We then move on to the dividend discount model. We have the growth rate year on year, as we can see, around 3%, which we did discuss earlier. Forward looking, we're expecting roughly around that 3.25, and this gives us an intrinsic value of $67. So we have our second undervaluation signal. We then move on to the DCF model with the average growth rate of 20%. Forward looking, we've gone more conservative, below analyst targets of 6%. With a discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we can see a third and final undervaluation signal. Now, the intrinsic value in today's episode is purely the average of these 3 models. And don't forget, you can click on the pinned comment below so you can grab this valuation model to get to both the intrinsic value as well as the acceptable buy price of companies in your own portfolio or those on your watch list. Now, margin of safety, we will start off with 10%. Remember, on this channel, we only execute on 10% if it meets 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. We then keep going till it's near the current trading price, and in today's episode we can see it is pretty much around a 15% MOS level, $54.89, current price around $55. So based on these estimates and judgments, we do see Realty Income at a 15% margin of safety. For those that want to see at other levels at 20%, it would be a buy at $52, at 25% around $48, but as we said, today's episode a 15% level. In terms of Wall Street and their expectations over the next 12 months, well, their price target is $61.21. They see upside of 11%. And what we have said earlier, we are in fact holding this company. It is one of those in our portfolio. But right now, a 15% margin of safety isn't one that we are considering adding to right now. But if this does come down to a 25% margin of safety, which is around the $48 to $50 mark, this is one we will continue to add. So in roundup today, summary, we do have Wall Street indicating this is a buy. We have a 15% margin of safety, and we do see around 11% upside based on their targets. As always though, do let us know your thoughts in the comments below. Is this one you're looking to add? Maybe one you're looking to hold? Or maybe for whatever reason, it is one you are looking to sell. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, let us know your thoughts below, and we'll see you all on the next one.